Hello and welcome to the latest video update for the Henderson Alternative Strategies Trust. Today I'm joined by co-managers James de Bunsen and Pete Webster. Guys, thanks for joining me today. So Pete, first off, let's start by looking at the number of holdings in the trust. The number has gone down a little bit from the end of January, where there was about 53 to now about 47. What can you tell me about those? Were they opportunistic sells or were they very deliberate moves?
Yeah, sure. So there's a couple of reasons why the number of holdings have fallen this year. So when we inherited the fund, there were quite a lot of holdings with zero or very little value attached to them. We've had a very successful period in actually getting rid of a few of these holdings and fulfilling actually liquidation processes. So a number of stocks have fallen out of the portfolio for that reason. The second reason is that this year we have done a bit of a review of the portfolio, and there are a couple of stocks that haven't performed in the portfolio that we feel don't truly meet the mandate's rationale. So we believe both PolarCap, Global Financials and Biotech Growth Trust are investments that our investors can get access to themselves. So we've sold these positions and we've built up a little bit of cash in the portfolio as a result.
Thanks, Pete. Now, James, it's been a pretty difficult time for investors at the moment. There's a lot of market uncertainty, but as multi-asset investors, it gives you access to a universe with an array of opportunities. So what is it you can access or you can find that your traditional equity investor can't?
Yeah, I think there's a couple of areas that we've been adding to recently in credit markets and in property market. So in terms of credit, we bought a fund which mainly invests in investment grade floating rate bonds, but it's a structured credit fund, so it's slightly more esoteric and there's a kind of complexity premium to it. So we've allocated some capital to a specialist credit manager based in New York. The fund yields about 7%, and these bonds have a very, very low default rate historically. So we think it's a good investment, a bit of capital appreciation potential as well. So that's an area we like. And then in the property sector, in the UK, we think the industrial sector has still got some good value, and that's particularly focused on the sort of warehouse segment. So this is a play on, the rise of e-commerce. And the fund that we're in, which is called Urban Logistics, that basically buys warehouses sort of around big urban centres, close to motorways, and it's a key part of the whole sort of logistics chain that is plugging into the whole growth of e-commerce. And we also actually think that German property still is a very good story. There's a structural supply-demand mismatch, a very strong labour market, growth is okay, and you can also borrow very, very cheaply in Germany because rates are so low in the Eurozone. So, yields are still attractive, debt's very cheap. That's a good mixture in the property sector.
So lastly, Pete, how would you describe the trust's performance over the last 6 months, and what would you reasonably expect going forward?
At the end of May, the fund's NAV was up 4.6%. We have lagged global equity benchmarks, but we believe that is a result of how well we held up in the volatility of the fourth quarter. We've also faced a couple of stock-specific issues, mainly from Riverstone Energy Limited and SIBA, the Cuban property owner and developer. These stocks have both been impacted by political instability in terms of trade war rhetoric and slowing global growth hitting oil prices, and possible increased sanctions against Cuba from the US in the case of SIBA. Going forwards, we believe investors have probably seen most of the returns they will see for 2019, and the second half of 2019 will be characterised by lower returns. As a result, the portfolio is positioned very defensively. We are looking to protect capital at the moment, and we believe we may get some opportunities to add more risk and more attractive valuations than we see today.